Did you know that investing even a small amount of money regularly can grow into a significant sum over time? It's like planting a tiny seed that can grow into a mighty tree. This is the magic of compounding, where your money earns more money, and then that earned money earns even more. Amazing, right? This is why it's so important to learn about investing, even at a young age. A book called Security Analysis by Benjamin Graham and David Dodd can teach you how. This book, written way back in 1934, is like the Bible of investing. It's still relevant today because it teaches you timeless principles about how to invest wisely. Why should you care? Because learning how to invest can help you achieve your dreams. Whether it's buying a car, owning a home, or traveling the world, it's about taking control of your financial future. Think about it. Wouldn't it be great to make your money work for you while you're busy living your life? Benjamin Graham and David Dodd were like financial detectives. They believed in carefully analyzing companies before investing in them. They didn't just follow the crowd or listen to rumors. They dug deep into financial statements like balance sheets and income statements to understand a company's true worth. They taught that investing is not about gambling or trying to get rich quick. It's about being a smart owner of businesses. Would you buy a whole store without knowing how much money it makes or how much debt it has? Of course not. Graham and Dodd believed you should apply the same logic to buying stocks. Their approach, called value investing, is about finding hidden gems. Companies that are worth more than their current stock price suggests. It's like finding a dollar bill for 50 cents. Think about this. If you could buy a share of your favorite company at a discount, wouldn't you do it? One of the most important concepts in security analysis is the margin of safety. Think of it as a financial cushion that protects you from losses. Graham and Dodd stressed the importance of buying stocks at a price significantly lower than their intrinsic value, what the company is truly worth. Why? Because even the smartest investors can make mistakes. The future is uncertain, and a company's fortunes can change. But if you buy a stock with a margin of safety, you have a buffer to absorb potential losses. Imagine you're buying a used car. You wouldn't want to pay the sticker price if you knew it needed some repairs, right? You'd want to negotiate a lower price to account for the potential costs. The margin of safety is like that discount. It helps you buy stocks at a bargain price. Think about it. Would you rather pay full price for something or get a great deal on it? Before we continue, if you're enjoying the content, hit like and subscribe for more insightful summaries. Value investing, the approach championed by Graham and Dodd, is like treasure hunting in the stock market. It's about finding undervalued companies that are overlooked or misunderstood by the market. These companies may have temporary problems or be in out-of-favor industries, which makes their stock prices lower than they should be. But remember, price is what you pay, and value is what you get. A great company is not always a great investment if its stock price is too high. Value investors look for companies with strong fundamentals, such as solid earnings, low debt, and good management teams, but whose stock prices are trading at a discount to their intrinsic value. Think of it like this. If you found a beautiful house in a great neighborhood that was selling for half its market value, wouldn't you want to buy it? Value investing is about finding those bargains in the stock market. Think about it. Would you rather invest in a company that's popular but overpriced, or one that's undervalued but has strong potential? Graham introduced the concept of Mr. Market to explain how emotions can influence stock prices. Imagine Mr. Market as a friendly but often irrational neighbor who offers to buy or sell you stocks every day. Sometimes his prices are reasonable, but other times they're driven by fear, greed, or other emotions. The key is not to let Mr. Market dictate your investment decisions. Don't get caught up in the hype or panic. Remember, you're a business owner, not a stock trader. Focus on the long-term value of your investments, not short-term market fluctuations. Think of it this way. Would you sell your house just because your neighbor offered you a low price one day? Probably not. You'd consider the long-term value of your home, not your neighbor's emotional state. Think about it. How can you avoid letting your emotions control your investment decisions? Security analysis is not a get-rich-quick scheme. It's a guide to becoming a smart and patient investor. It teaches you to think independently, analyze information critically, and make informed decisions. These skills are valuable not just for investing, but for life in general. Remember, investing is a journey, not a destination. There will be ups and downs along the way. But by learning from the masters like Graham and Dodd, you can navigate the market with confidence and achieve your financial goals. So, are you ready to unlock the secrets of security analysis and embark on your investment journey? For further exploration, consider reading The Intelligent Investor by Benjamin Graham, which is considered a more reader-friendly version of security analysis. You can also learn more about value investing from resources like Investopedia and The Motley Fool. We reached the end, but before you leave, let us know in the comments if you are going to read the book. Also, join our community of passionate readers by simply subscribing to our channel, where your love for knowledge and great stories truly matters.